Welcome to Intralink's reporting season economic update. I've obviously got Fred Strauss, Chair of our investment committee here at Intralink, just gives a bit of an update on obviously economic conditions and also the recent reporting season. Maybe just gives an update around the Australian economy, Fred, to start with.
Yeah, I think, Paul, the underlying theme really of the Australian economy has been this very successful transition away from growth being generated by mining investment. If we look at the GDP growth for Australia for the financial year ended 30 June, it was close to 3%. So a pretty good number, given the decline in, like I say, mining investment.
So how did it enable to do that? You know, obviously a pretty strong number. You know, how did it actually happen?
Yeah, obviously mining investment, all the mining companies added capacity. So, and a lot of those projects got completed and moved into production. And obviously from that, we saw a sharp increase in exports. At the same time, there was a decline in imports as well. Mining companies obviously importing less now, mining equipment, materials, because all those construction projects got completed.
Yes.
So the net result of increased exports, decline in imports had quite an impact on the GDP growth. And the other component of GDP growth that was pretty positive is housing construction. And not so much the contribution it makes to GDP growth, but it's more the flow-on effects of housing construction. Obviously, the Reserve Bank of Australia lowered interest rates over the last 2 years. The last action was in August when they lowered with a quarter or 0.25%. Then in September they remained on hold, didn't do anything. And looking forward, I think the Reserve Bank is happy to be on hold. They didn't give any indication in that September meeting of where they're heading as far as interest rates are concerned. And I think for the next few months we're definitely on hold. I think they're also keeping an eye on the US Federal Reserve, what they're going to do. The US Federal Reserve had their meeting last week. They decided to keep rates on hold in the US, but they've given a pretty clear indication that they're going to hike interest rates this year, and most likely that will be in December. And then they've also given an indication the expectation is for next year is to hike interest rates twice next year. So I think we're still on track as far as the US Federal Reserve policy is concerned, that they're going to start normalising monetary policy in the US and slowly but surely increase interest rates.
I suppose the wider US economy, how's that tracking along?
Yeah, it's been a bit soft over the last 6 months. So if you look at GDP growth for the last 6 months, has been a little bit disappointing. But the US Federal Reserve, in their statement after the meeting last week, indicated that they've seen a pickup in US growth in the third quarter. So I think the third quarter GDP growth number will probably be quite a bit better. But the story in the US has really been employment. A lot of high number of job creation in the US over the last 3 years or so. And the unemployment rate in the United States is now 4.9%, meaning they're at full employment. And the next phase really is wage growth coming through, and that should provide a nice boost again to that US economy. The Chinese authorities took some action over the last couple of years to cool down the housing market in China. And obviously that had an impact on economic activity, and we saw a pretty sharp decline in economic activity in China, and obviously last year that caused a bit of concerns to markets worldwide. The Chinese authorities then, towards the end of last year, started reversing some of those policies and relaxing them again, and we've seen a nice pickup in economic activity in China for the first 6 months this year. And I think that's also a reflection of what's happening in commodity markets, commodity prices, much more stable. I think because everybody's a bit more comfortable with what's happening in China. I think broadly speaking, most companies reported in line with expectations. This is a broad brush overview on it. I suppose from our perspective, with some of the investments in our portfolio, the standouts were probably Ramsay. Ramsay reported very well, private health. Its Australian operations doing very well, UK doing very well, and then France was a bit more subdued. But overall, a really good result, very good result. and a very good outlook for next year. Aurora was the other one that reported very well. Aurora, that's a spin-off really of the old of Amcor really, and since that demerger from Amcor, Aurora has been expanding into in the US.
Yes.
It's a very fragmented packaging market for Aurora in the US, and I think we'll keep on seeing them making some bolt-on acquisitions in the US to boost growth. The Australian operation for Aurora or market is a bit more mature, but that growth is really coming out from the US, and we're obviously attracted to that US exposure through Aurora. The last one, perhaps Seek. Seek, as we know, over the last 2 years has made a lot of investment to broaden the product range. To get a bigger slice of that, the recruitment market, let's put it that way. And I think there's clear signs that those investments are starting to pay off. And I think and management, I've attended the management presentation, and management is pretty confident of what's happening there. So I think going forward, I think Seek we should see some good growth continue. Yeah, nothing major as far as from our investments. Two, perhaps one can point out a little bit is CSL.
Yes.
Underlying operation CSL doing well. Outlook for next year very, very positive. The only downside, a little bit of negative with CSL is to do with the vaccine business. Recently acquired vaccine business. That's making losses larger than really bigger than expected.
Yes.
And CSL previously indicated that that business should break even by 2018. They've now revised that to 2019. So there was a little bit of disappointment there. But like I said, the outlook for CSL is pretty positive. There's a lot of product development. They're expanding still manufacturing capacity, etc. So going forward, pretty confident with CSL. The other one was Telstra, decline in earnings. Although they increased dividends and they've announced a share buyback. Yes. Because they do generate a lot of free cash flow. Quite a bit of that free cash flow is coming from NBN. As users transition off that copper network, they get payments from NBN. So there's significant free cash flow at Telstra. They're also investing now in network. New technologies, etc. So again, although they reported a bit disappointing, the outlook is more positive.
Okay, well, thanks, Fred. Thanks for that quick snapshot and summary of some of our key holdings. Obviously, any questions, please obviously have a chat to your advisor, and we look forward to helping you. Thank you.